We're going to cover a couple bullet points. These are common questions that I get asked by friends, clients, coworkers. I mean, they're just the common questions that are out there right now. And they're probably questions that some of you have. So I'm going to share a few of them. The first thing we're going to talk about is, are we in a housing bubble? This doesn't seem sustainable. We're seeing home prices continue to rise. Here in Shasta County alone, home prices have gone up 20% since the first quarter of 2020. So, what does this look like? Where is this going? How does this end? And I want to talk about that briefly. So, the first thing that I like to tell people is, most of us that were around during 2008 and 9, when we saw the Great Recession, most people are aware that that was caused from bad mortgages, subprime loans specifically, where people's payments were doubling and tripling. Completely different scenario than what we have today. What we have today is a supply and demand problem. In 2009, when we had the Great Recession, we saw a ton of foreclosures. We saw a lot of builders that were national builders go out of business, and the backlog of homes to replace the amount of families that need to purchase homes right now it's just incredibly backlogged, and we're never going to catch up. I think we need to charge it. Looks like we're running low on battery here. So different scenario than what we had in 09, and a lot of people know that. So specifically, give me while we had to switch computers here because we had technical difficulties with my Mac. So if we look at what we have going on today, we have a lot of millennials that have come into the housing market over the last few years, and we just haven't had enough homes to meet the demand for the families that need to purchase homes. One statistic I heard was, this was about a month ago, back in 2007, there were 4 million homes for sale nationwide, and I believe there were probably about 3 to 4 million people that were needing homes at the time. Today, there's somewhere around 1 million homes for sale nationwide, and we have about 8 million more households. So it's an incredibly challenging situation nationwide. This isn't just Shasta County, and until we see more supply or less demand, prices will continue to go up. It's a very simple supply and demand problem. So what are the situations that could change that? And we're going to kind of jump into the next bullet point. One of the things that everyone's looking at right now is inflation. There was a CPI report that came out yesterday, Thursday, and basically CPI is at about 5%. And what that means is everything that people are buying right now costs about 5% more than it did a year ago. That's stripping out food and energy. If you added food and energy back into that number, it's probably a much higher number. Now, 5%, it's really not that big of a number, but what we have to pay attention to is that the number was just a little bit over 3% last month. So it's going up pretty quickly, and that's something that we're all looking at. So if inflation continues to be a challenge from all the stimulus and money that the government's been printing, the only way the government really has, the only method they have to slow inflation is to rise the Fed fund rate or the federal interest rate, the federal discount rate. That's all the same thing. They're going to raise the rate that they loan money to banks, which will cause mortgage rates eventually to probably go up. And so we've been saying this whole year, and we've been being told by a lot of the guys that we follow, expect rates to go up. Inflation will cause rates to go up. That will slow the housing market. But just to be clear, no one's saying, no economists, no housing gurus, no one is saying that we're going to have a pop of a bubble. We're going to see the housing market drop dramatically. What we're hearing is, if rates go up, it will soften housing. The demand will decrease, and it will pull back the insanity really that we've been seeing the last year, with the multiple offers, people bidding way above asking price, and that wouldn't necessarily be a bad thing. So inflation is something that we're all going to want to keep our eye on as we go forward. So most people have been saying that we're gonna see inflation continue to go forward. There are some economists that are saying the worst of inflation is behind us. I don't really know. I'm not qualified to answer that question or not. It's something that we're all just gonna have to pay attention to month by month. But it's a real thing, and if you're anything like the people that work for me or the people that I work with or my clients, we're all seeing it. I mean, you go out and try to buy anything, a car. You go to the grocery store, you go out, you go online to buy anything. Number one, you're seeing it cost more than it used to. Number two, you're lucky if you can find it, because it's hard to find things right now. And that's a symptom of this high demand. Everyone has money, everyone's trying to buy things, and the supply is low because of the backlog in the supply chain, and it's creating the problem that we have today. So let's talk about mortgage rates. Currently, mortgage rates are really, really low, and that was one thing that was a little bit surprising, that we are seeing rates as low as they are today. I would have expected them to be higher. Yesterday, when that CPI report on inflation came out, we expected rates to go up. As mortgage lenders, we get these reports that come out regularly, and every day we'll get a text alert, basically saying if you have clients that are buying a house or going into a refinance, you should lock them in right now, because we're seeing data that's telling us rates are going to go up. And Wednesday, we were all warned that we should lock in our clients, because this report that came out Thursday should have had an impact on rates. It didn't, and we don't really know why. It was kind of shocking. So all that to say, we're telling most of our clients right now that we expect rates to go up towards the end of the year. But I want to just throw out there that I've been telling people for 10 years that rates are going to go up, and they just keep going lower. And so at this point, it's hard to say what's going to happen right now. I mean, if inflation does start going down from here and the worst is behind us, we may see rates stay where they're at and even go lower at the end of the year. But for most people right now, the prudent thing to do if you're buying a house is lock your rate as soon as you get an accepted offer. All right, so the next question we have. A lot of people have a lot of equity. If you bought a house last year, I heard this stat yesterday. If you bought a house in 2020 at the beginning of the year, with the average price point in Shasta County, you are $58,000 wealthier because of the 20% of equity that you now have in your house. And if we go back to 2007, one of the things that happened right before the Great Recession is this word FOMO, which I didn't know what that meant until last year, but fear of missing out. A lot of people started getting into this frenzy. They saw values going up. Everyone saw this opportunity to jump into the bandwagon of owning a house. And then some people felt the scarcity of not being able to get a house, and so it created this sort of frenzy, very similar to what we're seeing right now. A lot of people that have homes right now have equity, and they're wondering what they can do with it. And I want to just touch on that for a second here, because the equity in your house is not wealth until you convert it, whether you sell your house and you take that net worth out, or if you refinance your house and you pull some of your equity out. Those are the ways that you can access the money. Otherwise, if you write down that my house is worth $400,000 and I only owe $200,000, you really don't have that money. You have a perceived idea of value in your house, but it's not really value until you convert it to a dollar by selling it, or you look at maybe pulling equity out. There are people right now that are taking advantage of that equity, and there's a few ways that you can do that. One way is people are doing what's called a cash out refinance, where they're pulling some of that equity out to remodel their house, or to pay off higher interest rate debt. And it can be a good idea to do that if you own a house and you have a lot of equity, and you want to do some things around the house. If you want to pay off higher interest rate debt, that can be a good idea. There's a couple things to think about before you do that. Number one, is there a better option? Sorry, I was just looking at a note here. Is there a better option? Can you get the money cheaper anywhere else? Some people that have assets with a stockbroker, depending on how much money you have, you might be able to take a line of credit against your portfolio. Those rates can be as low as 2%. That might be cheaper money than what you can get against your home. Some people have savings. Some people have family that can give them money or loan them the money with no interest. If there's a better option for you to borrow money to pay off higher interest rate debt or to remodel your house or to upgrade your house, that's something you should consider first. Number two, is this putting you in a worse position than you're in now? A lot of people right now that are pulling equity out of their house are getting a lower interest rate than what they currently have, and they are not increasing their monthly mortgage payment, or they're increasing it by a very small amount. In that situation, it could be a very good idea. And the last thing is, what are you pulling the money out for? If you're pulling money out of your home to add to your net worth, to improve your life, or to get out of higher interest rate debt, those are generally really good ideas to do it. I don't think it's a great idea to do it to buy a boat or a car or to go on a vacation. Those are bad ideas. Those are some of the reasons why a lot of people got into trouble in 2007 and 8. But if you are thinking about taking money out of your house to put back in your house and to improve the kitchen or the bathroom or things that will absolutely increase your value, or if you have credit card debt, 10%, 15%, 20%, and you're going to pay that debt off and get those monthly payments out of your monthly cash flow, those are really good ideas to consider it. So these are some things people are doing. The last thing I'll say is we do have some clients right now that are seeing the opportunity in buying rental properties. We do have a lot of clients that are pulling money out of their house to get that 20% down payment to purchase a rental property, to purchase a short-term rental like a vacation rental in an area like Mount Shasta or an area that has a high demand of an Airbnb type property. These are some of the other ideas that people are doing. They're taking money out of the property and trying to put it to work. So if you have any questions on that, let me know. Do you have any questions yet? Okay. How do I get rid of my mortgage insurance without refinancing? This is another question people have right now. Because so many people have had such a large increase in equity over the last few years, some people want to know, is there a way to get rid of the mortgage insurance I'm paying monthly without having to pay all the fees to refinance? People in 2020, for example, many of them have rates in the 2s, and today rates are probably in the 3s. So it won't make sense for them to pay fees to do a refinance to go into a higher rate, but they definitely have more equity today than they did when they bought their house. So it's very simple. What you want to do is you want to call the 800 number on your statement. This is called the servicing department, and you're going to apply to remove the mortgage insurance, and they'll tell you exactly what you need to do. Some lenders may allow you to do it without an appraisal. Some may require an appraisal. But if you're paying mortgage insurance and you're happy with your mortgage rate, you don't think it makes sense to refinance, you should absolutely consider trying to get rid of the mortgage insurance on your loan. It could save you a lot of money. All right, the next bullet point we have here. Is it wise to pay over the appraised value for your next house? So this goes back to 2007 and 2008. We did see a lot of people back then doing the things we're seeing today, which is probably why a lot of people are feeling like history is repeating itself. We're going to have a housing crash. We're in the same thing we were in 2008, which we're not. But the question is fair, and I hear it all the time. Right now, if you're in the housing market, you're seeing people buy homes and they're offering over asking price. We've seen people offer over $100,000 for a home in the 400,000 range here in Shasta County. That's insane. It's not uncommon right now to see 15, 20, 30, 40,000 higher than what the seller is asking. One of our clients got 16 offers over the weekend, this last weekend. So a lot of people are looking at that. Is it wisdom right now to be paying over asking price or even over the appraised value? A lot of the appraisals right now are coming in lower than what the seller wants for the house, and the buyers are willing to pay the difference between the seller's price and the appraised value. And I want to talk about that for a minute. So the answer to that question is not very simple. It really just depends on a couple things. The first thing that we always want to go back to is, what are your alternatives? I've had clients recently that have come in to meet with me, and I have told them that they shouldn't buy a house. They didn't have a down payment. They were in a long-term rental situation with someone who was not going to change their rent. They were paying $1,000 to rent a house that should have rented for $2,000, and they were sure it wasn't going to go up on them. And for them to buy a house right now using a down payment assistance program, they would have had a payment that would have doubled or tripled just to get into the beginner house in our county right now. And so for them, it was probably a better idea for them to stay where they're at, save their money, better prepare themselves to buy a house at a later date, because going into a house right now just because it seems like a good idea wasn't a good enough reason to buy. Well, then we have people right now that have a large down there. They've moved into our area from another city, and the price buying a house at 400,000 to them seems like a pretty good deal when you're leaving the Bay Area. And for them, if they're paying $20,000 over asking price on a $400,000 home, that's only a 5% difference in payment. And the average home in California has gone up at 5% a year for the last 60 years. So if they're buying a house that they're going to be in for 20 years and they're paying 5% more than the seller's asking for it today, they're going to absorb that over the next 10 years. And for them, it's not really that big of a deal. The most important thing for them is finding a suitable home for their family that's affordable. And the alternative of renting right now isn't great, and most people know that. So it really just depends on the people's situation. The people that we're warning right now that they shouldn't jump into the housing market is when their housing expense is going to double or triple. They can't afford it. They're pushing that debt to income ratio into areas where if one or more of the people on the loan lost their job, it would put them in a really bad position. For those people, they probably shouldn't buy a house. The rental market, though, is something we have to talk about. And we talked about this last time. The alternative for more people to rent is also very challenging. And so one of the things we are seeing right now is we are seeing a lot of people leaving the area. And it's an unfortunate thing, but not just Shasta County, but California, as many of you know, a lot of people have been leaving for a multitude of reasons, political, but the housing expenses here has pushed some people out. So that's going to be something we're going to continue watching as we go forward. The last thing we want to talk about when it comes to housing prices, and this is something that I told a group yesterday that we had a meeting with, we have more pending sales over $1 million right now than I think we've ever seen. Do you remember what it was Jesse said yesterday? The 30? I think there's been 30 closings over $1 million in Shasta County over the last year. And I don't remember ever seeing this many pendings over $1 million. As of last week, there's 2 residential homes in Shasta County that are pending over $5 million. So that is something that's super interesting to watch. Historically, the higher end in our county, which would be anything north of 800,000 roughly, hasn't had a lot of activity. So it's been very busy in that 200 to 400 range. But for the first time and possibly ever, we're seeing a pretty high demand for that higher end home. And we've got more pending sales over $1 million than we probably ever had before. So that's something we're going to watch out for too. Other than that, I hope this was helpful. If you ever have any other questions, feel free to share them with us. We are going to record this video and put it on our YouTube channel. I'm always available to answer questions. Anybody that has questions regarding housing, mortgage, anything like that. I hope you guys have a great weekend.